Hi everyone. In today's video, we're going to be talking about donation of public company shares to your favorite charity during your lifetime. And we're going to see how it can play a role in your state plan. So the first thing we have to start with that this strategy is good for people who have two things. They have asset which is allocated towards estate or to the or towards their family after their passing, and second, they have a charitable desire to leave, to give something to some their favorite charity. So those two things has to be present in this strategy to consider further. So the number one thing, if we look at the donor like yourself, they can give the public company share to charity today, the favorite charity they like, and donor uses the that tax benefit to purchase a life insurance policy to replenish the state for the loss of asset which you allocated to the charity. So that's what we are looking at. Charity receive the public company shares. It can convert those shares anytime after it receives. So let's look at further. So if we look at this way, that the gift of public security charity. So the big, what is the public security? So it includes, like, stocks, bonds, mutual fund, segregated fund, stock option, but it does not include flow through shares. The flow through shares are excluded from it. So one of the thing which we have to see, that if you own a publicly traded security, you paid $100,000, then that security worth 500,000. If you donate that security to the charity, the the market value of the security is 500,000. There's supposed to be a capital gain which is 400,000. That capital gain inclusion rate will become zero if those securities are donated to the, so the capital gain will not be declared. So that something has to be considered. Second thing, we are assuming the, in this example, that the combined federal and Saskatchewan donation tax credit rate is 47.5. This rate is only available for the people who's only receive the highest federal tax rate if their taxable income which is subject to the tax at the top rate. So we are using the top tax rate and assuming that the people's income is at the top rate. So that's the assumption. So now, to make this thing visually appealing, so let's see, the number one thing, that you own a security and you donate that security to charity. Now the number two, what will happen at the fair market value, that secure that charity will issue a tax slip, and then you will file your taxes and you get your tax credit. Number three, you use that tax credit to buy insurance policy. And what, number four, at your passing, that death benefit will be paid to your family. So that's the four part thing will happen in this strategy. Now, if we will look at in a little bit more detail, so we are going to use a case study or example. In this example, we looked at the husband and wife. They both age 60, and they own a public company shares which they paid 100,000 for it, and now the value of those shares are 500,000. Now this is a good investment, so they have a huge capital gain of 400,000 on those shares. So what they can do, they can do this thing. They can take that security, donate it to the charity. They donate the 500,000 to the charity. The tax credit we are using at 47.50, they will get 237,500 in tax credit. We are not going to get in detail about their income. I have another video on that, and you can look into that how much you can how much tax credit can be used in any given year. Now they have 237,500 there. We in this illustration we use 10 pay Canada Life Par policy. We took that 237,500, paid that equal amount over 10-year premium, and that whole amount is used to pay by the policy over 10-year period. The first year death benefit will be 334,272, and at 30 year of the policy, at the current dividend scale, the policy death benefit will be around $580,000, $716. That death benefit is based on the current dividend scale minus one, so to be conservative. So you can see how it worked. From 500,000 went to the charity, the tax credit bought the insurance policy, and at the end, the death benefit went to the family. Now Now if we can revisit this, the benefits in this strategy. So number one, donor make a substantial donation today and can offset the tax liability which exists today. Charity receives a substantial donation today, you see the benefit going to the people and the charity you really believe in. So that's something, it has huge value. Family receives the recognition of the gift today. If the, you see the benefit, as I said, going to people and the charity. Donor fund estate replaced the insurance during net tax benefits. Donor estate received death benefit funded by the tax saving from the donation. So that will, the estate get republished with the death benefit. And in this way you are able to do two things: you are able to support the charity, and you also left something for your family. So in this strategy, the one thing which we have to consider, in if the donation is made after 2023 tax year, so if say in 2024 tax year, alternative minimum tax is going to play a part. The potential of alternative minimum tax is going to come in, because where it's going to come in, because the capital gain which existed on the securities but was not declared, it's a large donation and the large capital gain, it can trigger alternative minimum tax, and will also depend on other income. So before this strategy has been considered, it will be a good idea to talk with your tax professional and your advisor, or if you want to talk to me, please reach out to me, and we can look at it, that how this strategy can benefit you. That's it for today's video. If you enjoy watching and you have any friends and colleagues and family that might find value in this thing, please feel free to forward it. Also, if you have any question and you have any comments and you have anything you want to know more about it, please reach out to me. I will be happy to chat. And thank you very much for your time, and have a wonderful day, and talk to you soon.